Morning, everybody. Ryan, if you're trying to talk, we don't hear you, mate.
Oh, that's because the button was on mute for some reason. Thank you. Yeah, so good morning, everybody. Welcome to the Flow Show. Here we go again, doing battle with the markets. You all right, mate?
Yep, all good, all good. Bit of a shortened night with our Australian CPI and the RBNZ then, but yeah, all good, man.
Good to hear it, mate. We shall obviously look at the data in a mo. We'll just get through some of the other headlines first. PBOC still pulling the fixes down, now sitting at 7.1031, down from the 711s into the 710s. And we look like we might be getting a little bit of a break down under my expected zone, but not quite. Came down to the bottom of that zone and hitting that 38.2 fib. We've seen a little bit of a bounce, but as I was saying, it was looking like it might be wanting to break up, but still a bit of a coin flip. And the moves from yesterday in bonds, yields, and the dollar has seen it edge lower. So keeps the downward pressure on, which is good for my book at least. But it's hit the support area and bounced thus far. Over to the Bank of Japan, and BOJ's Adachi says that the steps the BOJ took in October to make YCC flexible is not aimed at laying the groundwork for policy normalisation. So he's really speaking on the dovish side of things. However, he did concede that he sees a risk to Japan's inflation outlook skewed to the upside, but then countered that to say we're not in a stage now to debate an exit from easy policy. Now, the Nikkei was floating around a headline that the Japanese government was going to lift its assumed rate for debt servicing for the first time in 17 years, which may sound like a big deal. It is a bit of a big deal, but this was touted by Kyodo News a couple of months ago. They're potentially going to raise it from 1.1% to 1.5%. This is just another little measure that they moved some other rates up as well for the first time in a long time. So the process is underway of lifting rates in Japan, even if they're on a small scale and not anything that is monetary policy related thus far, but still moves are moves and rates are going up. Right, coming over to, we'll start with the RBNZ. And they left their rate unchanged at 5.5% as expected, although there was a bit of a hawkish tilt to the statement and to the comments from RBNZ's, or they issued their latest forecasts, which showed their forecast for the OCR rate just ticking up a bit higher across the years for those. So they see, well, the forecast see just a touch higher for the cash rate. The forecast show no rate cuts until mid-2025. And the statement said that the OCR will need to stay restrictive. The main change in the statement was in the latter part where they talk about the committee is confident of this, that, and the other happening. Their prior statement was saying that they were confident that the rate was restrictive and it would reduce demand and bring inflation down to their 1 to 3% target. But this month they put in a bit more of a cautious, hawkish note saying, however, ongoing excess demand and inflationary pressures are of concern, given the level of given the elevated level of core inflation. If inflationary pressures were to be stronger than anticipated, the OCR would likely need to increase further. Then we had comments from Governor Orr saying that they discussed a hike at this meeting. Said we are willing to raise rates if necessary, and the risk to inflation is to the upside. The main tone was that rates are in restrictive territory. We know this language from other central banks. There's restrictive and there's sufficiently restrictive. That's the switch we're waiting for Powell to issue. But the RBNZ, they're in restrictive, not sufficiently restrictive yet. So it's a bit similar to what we heard from the the RBA that inflation isn't coming down as fast as they would like. Demand isn't softening as fast as they would like, and that's keeping them on the hawkish slant. What did you make of these, like the RBNZ last night, mate?
Much more hawkish to me than what may have been expected.
Yeah.
Much more. I was really not expecting them to keep a well, I mean, it's not over 3 years. It looks like a full hike, but then really it keeps half a hike also in place for the start of 2024, and I really thought that they would take that out, to be honest. But they didn't, and they're still wary about inflation. So we had, yeah, what the aftermath of the whole thing is that because when we look at the Kiwi where we are now, we are where roughly where they came up with the statement, right? So the market is probably was surprised. We had the jump above 62 in the Kiwi. Perhaps also a bit of month and things going on, because at the same time we saw dollar yen tank and euro dollar and cable printing their highs. Yeah, the thing with Orr is that he can flip from one meeting to another, and so perhaps that's why we are back here where we are in the Kiwi, that the market says, like, the market knows Orr by now. He already did a few saloon doors in the past, from one meeting to another, and perhaps this is another one. I mean, based on the data that we had of late, I said, like, I expect it rather to be a dovish hold, but it was clearly a hawkish hold. Now,
again, it shows how scared these guys are. You know, we had it from the RBA, we had it from the BOC. They just don't know what inflation is going to do, and they're just, you know, they're just rolling with each data point.
They are just like us. They are watching the data, and as we have already said a couple of times, and you also mentioned that, is that they are too scared to go to start cutting too soon now. So better stay over tight there for longer this time because of the inflation. But yeah, I don't. It's something. It was hawkish, but then yeah, and the market then reacted for about an hour, and then started to slowly come back down. Now remains to be noted and to take into account that they are at 5.5%, which is in the sphere of the developed countries the highest interest rate. The states are close at 5.25 to 5.5, but the RBNZ is the highest. It's also, one could argue, is that perhaps in line with Swiss somewhere, it's also one of the smallest markets in the developed countries. I'm not going to say the majors, because the Kiwi can hardly be called a major, such as euro or dollar or yen or sterling, for instance. But yeah, there's still a high yielder in the meantime, and that may prevent the Kiwi from weakening. Here, since it's not such a big, deep market, here I think the data are really going to get the Kiwi on the move, I think, in future, especially if we see the line continuing that has apparently started over the last few data, barring the CPI. I mean, the real street data of the economic data, not the inflation expectations also. But they have started to weaken a bit, and if we see that continue to weaken, then we are going to be betting on a dovish flip quite soon from Orr, because as I said, he has this habit of possibly flipping, really doing 180 from one meeting to another, more than other developed central bankers.
Yeah, exactly. I mean, you know, compare it to the Fed. The power doesn't swing between data points like these guys do, and it's important to know it's important to know the thinking behind all these central banks. Okay, it's okay if they're hawkish and wrong, i.e., they keep these hawkish messages in and they're wrong, because if they're wrong, inflation is going where they want it to. Where they come unstuck, like they got unstuck in the whole inflation spike up, is that they were wrong on the dovish side. So if they're too dovish now and they need to hike, they get egg on their face again. So it's okay for them to be wrong, sound hawkish, and not need to hike, than be dovish and then need to hike. So you've got to. That's the thinking behind all these guys. This is why I'm saying that for central banks, particularly into the end of this year and these last meetings that we're going to be getting in December, they're not going to let go of the hawkish angle. They're going to keep it in there, kick themselves into the new year, and then see what happens then. Because the last thing they want is a market coming in bright and breezy in the new year and suddenly going full tilt dovish. Otherwise, they just end up undoing all their work and they face a harder fight. Next year, different kettle of fish. But for the rest of this year, Orr and the likes are going to keep their hawkish slants in play. As Kay mentioned, the Aussie CPI data, the measure there's only one measure coming up. I can't remember what else come back. I haven't looked back on it, but a little bit softer there on this weighted mean CPI year on year, 4.9% versus 5.2 expected. Still lofty levels though. So, still, they may say that's coming down a bit faster than they would like, or that they've seen previously, which was one of the reasons they hiked again, because it wasn't coming down as fast. But that might help them out a little bit on that side. Now here we have another flip-flop of sorts. Riksbank's Floden says it's fairly likely no further rate hike is needed. Correct me if I'm wrong, Kay, but they also said that a hike might be an option in January or something at their last meeting. So, again, they're playing both sides of the coin on this one.
Yeah, exactly. But there's a few different opinions going around within the Riksbank right now. So the one can be talking to one side and another one to the other side. We have seen that already happening. But yes, it's well, I mean, it's just we just have to pen it down and wait and see what they are going to do on the next one, because if we get one stubborn inflation print, Floden can change his mind again. So I'm not reading too much into that one, and I must say.
Yeah, exactly. BOE's Haskell was out saying that labour market tightness will need higher rates for longer to get inflation sustainably to target. Rates will have to be held higher and longer than many seem to be expecting. And there's no scope for rates moderation anytime soon. So another banging drum for the higher for longer message. Now, let's have a quick look at some of the data out this morning. In the Eurozone, we had the German regional CPI numbers all dropping. But as you can see there, we also got some Spanish flash numbers there. CPI dipping back to 3.2%, was expected to rise 2 pips. Instead, it went down 3 pips. The Eurozone measure as well, doing pretty much the same there. So things going the right way for Spain. Coming down, as I said, the German numbers, big losses on the regional CPI numbers. If you look at them here, Baden-Württemberg down to 3.4% from 4.4 expected, down from 5.1%. We're even seeing some two handles on these. Bavaria 2.8 from 4.1. Brandenburg 4.1 from 5.6. So big losses here in the German numbers, which we've been hearing from Bundesbank and ECB man Nagel for pretty much every day, mostly banging the hawkish drum. There'll be some relief from him regarding that. And on the ECB, we've had Stornomas coming out, mentioning the dreaded C word. He said that the first rate cut could come in the middle of 2024, but an April cut bets seem a bit optimistic. He is a big dove at the ECB, so no surprise there. I wonder if he's going to get a little bit ticked off from Her Majesty for even entertaining thoughts and dates about cuts and stuff. We know the market is very sensitive to cut talk at the moment, as we saw yesterday with Waller, which I'll touch upon shortly. Over in the UK, we've got some data out, some mortgage data. Mortgages approvals coming in healthier than expected, 47.3k, above the 45 expected and higher than last month. Also look at the Bank of England consumer credit data to see if there's any red flags being waved there. It came in lower, 1.29, 1.3 billion versus 1.5 expected, lower than last month. And as usual, I look at the splits, how much is going on credit cards, how much is going on other loans. Credit card use was down to 500 million from 600 million. Credit growth was pretty healthy in terms that it's not looking like people are borrowing unsecured credit and other measures to prop up their finances. That's all looking tickety-boo. Savings jumped to near record levels in the last month as well. So a lot of people putting money in the bank. So again, that's another sign that people aren't maybe as strapped for cash as our press likes to make out. There was a bit of a big switcheroo around in various saving assets, accounts and whatnot, due to high rates now being offered, people getting out of old current account deals that offer pittance and jumping into, fixed rate deals. You can get deals for a couple of years, rates fixed at certain levels or up to a certain amount of deposits. So people doing a lot more shopping around to get into some of those higher rate accounts. But overall, nothing to worry about as far as consumer credit goes in the UK. What we have had, though, just something I've picked up just when you watch the wires all day, every day, like I do, I'm seeing more and more headlines crossing about job losses coming in from various firms and sectors. We previously heard a few weeks ago that Citi was going to be cutting positions. Apparently, they cut 7,000 jobs in the first 9 months of the year. Lloyds Bank is expecting to cut 2,500 jobs. Barclays apparently has 900 jobs at risk of redundancy. And obviously yesterday mentioned the Volkswagen potential job losses, sizable ones in Germany as well. Now these bank ones, 900, 2,500, it's not huge numbers. So obviously it's bad for the people involved. But it's the rate that these job loss headlines are now seem to be crossing the wires. It gets me thinking maybe something is brewing finally on the jobs front, that we start to see some more negative numbers coming in. It's just something I'll keep an eye on, but my radar tends to pick up on these things when I see multiple headlines, all of the same sort of stuff. So we'll keep an eye on that one. Right, over to the US. Yesterday's data we got coming in, a few bits and bobs. Housing data or house price data from Case-Shiller and the F.A.C.E. This is for September. So if we look at the year-on-year numbers, the 20-city number there came in higher. Not as high as expected, but still rose 3.9% versus 2.1% previously. The national US number also rose to 3.9% from 2.5% previously. So house prices jumped in September. We've already seen house prices dropping in new home sales for October. So these numbers obviously might be a bit lagging, but the picture isn't too clear on the housing market on that front. Then we got the US consumer confidence numbers, which again, another improvement and a good bit of data, soft landing data for that, 102 versus 101 expected, up from 99.1. There were some big revisions lower, though, on last month, which you can say is negative on the prior month, but then it just makes the gain this month look bigger. So it's 6 of one, half a dozen of the other in terms of how you read that. What was a little bit of a change was the 1-year inflation expectations. That dipped back to 5.7% from 5.9%. So a little bit of relief on the inflation expectations, though they are still running hot up into the 5.7%. Now, I also mentioned that how the market is getting sensitive to rate cut talk. We had Fed's Waller out yesterday. He started off along his normal neutral lines, saying that he's increasingly confident policy is well positioned enough to slow the economy and get inflation to target. He couldn't say whether enough has been done, and hopes the data over the next couple of months will tell him what's what. Then he jumped in with saying if inflation consistently declines, there's no reason to insist rates remain really high, which the market read in cut terms and reacted to. That was part of the trigger for yields dipping as well. Although he did counter that and said that he didn't really know when that would be. It could be in 3, 4 or 5 months' time. So a bit flaky on when that happens. Overall, he's saying what pretty much the market is expecting anyway. At some point, rates will need to come down. But hearing it from someone like Waller is a bit of a big deal. But then Fed's Bowman came out. She's also a voter. And her first line was she favours hiking if the inflation drop stalls, and said it was quite possible we will need Fed policy at a higher level than pre-pandemic to foster low, stable inflation. So she pretty much came out a couple of minutes after Waller and went complete the other day. Fed's Goolsbee was out as well, a couple of appearances. One late last night saying that keeping rates high for too long is a concern, and that when they look to cut, the data will determine how fast we go. So a little bit dovish from him there. What did you make of the reaction to Waller yesterday, Kay?
Well, first of all, we have to know that Waller pretty quickly went from one of the hawks to be one of the doves now. So we need to take that probably into account as well, how fast he changes his mind. But it seemed to be well documented, saying that he expects perhaps a pivot a bit sooner than others. I do think a lot still has to do with what we're trading in month end and the market already being heavy on the yields. But he gave the bond market a good push behind the back. He's probably long bonds, or he's good pals with Bill Ackman. I don't know. But I mean the market really reacted to it. But then if you look at it where we are now, we're roughly back to where he came up with his lines, right? If you look at stuff like euro dollar, for instance. So I think a lot had to do with the market trying to find the top in the euro dollar, but then the flow still being there for selling dollars, and then it sparked this acceleration. Again, seeing that how quickly he changed from really, because I recall like last year, start of this year, him and another one, I don't recall exactly who it was we were calling them Statler and Waldorf, like Waller, and they were the Uber hawks. And now he seems to really fall into the doves segment. Yeah, I mean, we'll see really what happens, I think, after the end of the month for the bond market, because as I said, it comes also in a scenario where the market is seemingly needing to rebalance and to buy bonds and things for the end of month. So he really came up there whilst the market was still on it in the New York session, and pushed the boat really for the dollar. But yeah, the market is very receptive to lower yields or higher bond market or news or headlines. So that is still a fact. Because now, like he caused the 2 years actually lost quite a bit. The 2 year is actually the one that really, apart from other things, where the market is really looking at what the Fed may want to do or so. The 2 years is very heavily traded, and that really the 2 year yields collapsed yesterday.
Yeah, that was a pretty good indication. I mean, I was bemoaning the fact that we've been saying that the short end hasn't really been reflecting any of this dovish talk.
Yeah, and then it all of a sudden kicked in, right?
Yeah, then you get one of the big wigs talking
Yeah.
about it, and that's when you get the reaction. So
Yeah.
very significant.
So yes, that's the thing as well. I mean, we have to acknowledge that the market is reacting much more to those negative factors right now. Okay, I mean, that's about it. I'm not saying we've gone far enough, but I really want to see how this bond market reacts once this month is over, because there's a lot of talks about rebalancing stuff, and so we could see the crux of it, or the height of it tomorrow, perhaps, and then we will see where we end up, and how we start December. But yeah, the thing is that Bowman, she's now really the I think it's with Mester, perhaps the two Uberhawks left in the party, right? Sorry?
The holdouts.
Yeah, and that also, what I said in the room this morning, is going to make Powell's intervention on Friday, right? He has a double slot on Friday, and that's going to make his intervention now very interesting, because it will come at the end of the week. It will come at the start of a new month, and with the market in the mindset that it is now, he can either push things a lot further, or if he really fights back against it, have another wake-up call to the other side for the markets, right? So that's sort of where I am at right now. But yeah, the market is really receptive to lower dollar, to lower yields calls, right?
Yeah, and Powell will be the last we hear from those lot, because then they go into blackout from Saturday. I don't know if there's any other Fed members, but no one will care about those if Powell's speaking. So yeah, then we're into the blackout period. So it all goes quiet from that point onwards. So yeah, he's in a fireside chat, and then he's on a panel at this same event on Friday. I haven't seen what the subject matter is. So it may be nothing to do with monetary policy, but yeah, we have to be prepared to be unprepared, if you like. But yeah, my thoughts for the end of the year and these last meetings, if what happens, as I think might happen, is that these central banks, particularly the Fed, they keep the hawkish line into December. Any jump we get in the dollar, any jump we get in yields, I think that's your last chance potentially to get it on the, if you're trading bonds, get long bonds, and get short the dollar if you're trading FX. I think that's your last signal, because when we hit next year, it's all about the cuts, baby. And I would, as I've been saying, I've been getting twitchy about maybe getting short some dollar yen, but every time I put the screen on, it's another 100 pips lower. So yeah, I might be chained up chasing that one.
It was good you were in the wake overnight, because you could have sold it below 147 if you got FOMO then.
I would have more likely bought it down there, I tell you, but I probably would have been stopped out in that move, because I've been saying I like the 147, and I didn't get in this one, and so yeah, probably good that I wasn't awake when that happened.
Yeah, it's really worth noting as well for people watching those moves. You have the levels, you have your takes and whatever, but you need to know when those moves happened. And the two moves that we have seen on what Ryan is showing right there, the two moves we have seen are fixing moves. Okay, there's a lot of end of month stuff going on in there, and those two big dips that we saw happened around the Bank of Japan fixing time around the Tokyo, fixing time in both times. So that shows us that they have dollar yen to sell for the month end, but it also has to keep us on our guard, because if you look at the two moves that we had on the back of it, yeah, that's the one the day before, and then the last one here is the one we had overnight, and so you have to be a bit careful to see what you do, and not going to chase it down there if it's really around Tokyo fixing time, because usually we do see a corrective move afterwards, like we are seeing, for example, again today, and the same thing we saw yesterday, right? So keep when we are month end like that, and then there's been big moves on the equity markets and on the bond markets. Be mindful of the clock when you trade.
Yeah, and yeah, this could be significant that we did crack the egg down here at 147. I mean, look, we know we're in rally selling mode. We have been since the highs. We've had the dips. Every time it has a stagey little bounce, it gets whacked, it gets whacked, it gets whacked. But it's not going down without a fight. You know, the first test of 147, you could call it a technical bounce, whatever you want to call it. We also had Ueda coming out in this point as well and keeping his usual dovish self. We've got a bounce, couldn't quite get back to the 150. Sellers coming in, and then we're on our way down again, rally selling all the way down. But then we do see some significant bounces, so there's plenty of volatility in here.
Yeah, that's 100 points. Huh?
Yeah, so it's it's good volatility. If you jump in between the levels, all fine and dandy. And if you want to be short, you want this volatility, because it's costing to sit in dollar yen shorts. You want this volatility so you can take advantage of these moves. You get a quick 50, 60, 100 pip move, bang, you take some profit off, and then you look to reload it. That helps pay you, at the very least, your carry costs, which is important if you want to short this pair. You've got to be making money along the way, not just getting in and sitting in it and doing nothing when the profit's on your way. So yeah, I'm still fancying a short. It's a bit of a hope trade that maybe Powell or the FOMC gives us a decent kick up higher in this one. I'm expecting it. How high it might go, I don't know. We'll have to wait and see what prices are doing. But it could be a case I might end up chasing this one a bit lower. If we do get under this 147, then I know a lot of people in our room, Kay as well, we've got a lot of tech around this 146.30 area, this fib as well, which is going to be an important fib. It's the fib of the mid-year, let's call it, leg of this whole year's rally. I haven't got the fib from down here yet, because that doesn't come in till around there, 142. So got a way to go before I need to get my crayons out for that. So this fib is going to be important, at least for this leg. So that's the next level if we get under there. And as I said, I know Kay and a few other boys and girls in our chat room have got levels around that 146.30. Bottom of the cloud, I think it is as well, isn't it, Kay?
No, the bottom of the cloud is actually just a tad below here. It's in the high 147.30s, but
147.30,
yeah, but I have a trend line down there as well, around 146.65. We've got a few previous high lows there, weekly closes and stuff. But then the cloud, and I was saying in the room, for as long as we are in month end, I'm not going to bet on it. For as long as we're in month end, they have to do flows, right? And the flows don't care about whether there's a trend line, a fib, a cloud, whatever. They just have to execute those flows. So I would start to look personally. I'm going to start to look at the cloud again once December starts. For now, I've put it on bit in the fridge and see what happens. You also have around there. What is it? Is it the 100 also DMA? That's around 146.80s there.
Yeah.
Yeah. That also. I mean, although I'm not a big fan of moving averages, but then if you look at where we capped the rebound around 149.75, is around your 50 DMA as well. So I think we've got, like, if you want to start counter trading this, counter trading, if you want to start being short dollar yen, there's two things in my opinion. You have that level, that first level there around 149.75 is definitely where the market was sitting, trying to call it front run the end of month, but also looking at how the bond market evolved and the yields coming off elsewhere. You remember what I've been saying a lot of times. If the yen wants to materially strengthen, we are going to need the other side of the coin to help it. So that is something that is underway. Now, I think the second requirement is for the yen to lastingly strengthen, is that the yen crosses need to start to come off as well. And that for now is still an open question, because we've had similar moves in dollar yen than we saw on the euro dollar or on the cable or whatever. But then, yes, we are off the highs in the euro yen, and yes, we are off highs in the sterling yen, but we are nowhere near of breaking down. Nowhere near yet. And that tells me if we need to, you see, we're still trading at very lofty levels, right? And yeah, you can break a trend line, or you can break one or the other fib, but we are not starting to completely unravel in the yen crosses, and that is going to be, for me, the second requirement for the yen to lastingly strengthen.
Yeah, very much so, mate. Very much so, and that's the game we're going to be playing next year, most definitely.
Obviously, yeah, and I think it is possible. You know, I really think it is possible. Maybe we will have to be patient and wait for the Bank of Japan to effectively start to tighten. But I think the rest of the world, it's looking like we are going to go that way. Also, and we can't bank on one number, but those German CPI numbers have really started to come down now rapidly, forcefully. We've seen the Spanish CPI coming down as well this morning. We've seen also what's happening in the States, and also if you look at the German economic data, they are not doing well. So it is. There are signs it may be happening, okay, but we may need to be a little more patient. But I think once the crosses start to turn on the yen, it's the game for the yen can really start.
Yeah, exactly, mate. A quick look at before I hand it over to Kate for a look at a few bits and bobs. Just going to have a look at euro dollar. So we did have the break yesterday. Took it up over. Finally got through this 109.60 area. Huffed and puffed a bit. Then we had a move up over Waller and the like and the data over the 110. Couldn't hold it. Dipped back. Had another go. Couldn't hold it. Now we're just sort of finding resistance up there again. It needs to get above 110 and hold it. For now, the dips are limited just ahead of this prior break point and these prior highs, 64s. So we're holding just ahead of that. So it is looking still constructive on the break. We're doing technically what it needs to hold this break area, but it seems to be running into a bit of trouble when it gets up to this 110 level. So that's what it needs to take out and hold that. Then we go a bit further. If we don't, the longer we don't break that, the greater the chance we have a steeper pullback. And then, we perhaps go back in the short-term box. Again, as Kay's been mentioning, month-end stuff is in play as well. It's no surprise to see the softer data, seeing the euro lower on the softer data, inflation data that we saw today. They were quite significant drops for inflation. And that just makes the ECB's job a little easier, if you like, and certainly pushes any further thoughts of hikes further off the table. But we're only talking 20, 30 pip moves here, so nothing really significant. So, yeah, the move is still going. The rally that we've had going back now to late October, November, still in play. We're still making the moves up, still breaking the levels. That's what you want to see. It keeps the rally going unless we start breaking back down some of these old resistance points. We're ongoing. Cable's pretty much similar case. Had a little poke above the 61.8 fib, didn't like what it saw, 127, 127.20s, didn't like what it saw, and we're back down below the big figure. Got this just this intermediate line around 126.70s, and we're just deciding whether we want to stay above or below it. Really, this is your main area of support, 126, 126.40, 50, whatever you want to call it. That's your main area to keep an eye on now for cable. Get back down there, hold it. That'll give you perhaps a springboard to get into longs and for another move back towards the highs, and then we get to see what happens up here again. Do we build further resistance, or do we break on through and keep the rally going? So all these steps you've got on these pairs, whether it's Aussie dollar, Kiwi, or anything else, all you need to do is just keep an eye on the levels that broke, the levels that hold. There's your markers for whether the moves is going to continue or not. So if you missed out on it and you want to be long cable, you know where to look to try and get into longs. You're certainly not going to try and buy it up here, that's for sure. Well, not me anyway. Euro sterling, that's continuing to look weak up. We're now testing the bottom of my old zone. Let's just zoom it out a little bit. Could be seen as a little bit of a line in the sand here for this move. We've just edged below that prior low. So that's the first warning that maybe something is starting to change on this one. If we held that low significantly, fine. You know, it gives you extra support to lean on. But the fact we just moved down and we're knocking around this 50 area, bottom of this zone, get a break under there, and we could be heading back to the 86 big figure not too long after. Get below the 86 figure, and I'll start thinking about whether I need to tighten up on my longs from 85s. But for now, I think Kay's right that we're probably just seeing a bit of end of month stuff going on here. Obviously, cable always moves quicker than euro dollar, so there's a bit of that in there as well, purely from the dollar side, how fast euro dollar moves versus cable. So yeah, fundamentals, they're a bit in the balance. The UK, there's still a bit of positivity behind the UK from the last couple of weeks. Need to take that into account over the Eurozone at the moment. But as we know, that can change in an instant. Right, Kay, I shall hand it over to you, mate. Oh, actually, before we do, just want to look quickly at the US 10s.
Yeah.
Because we did have this break. You know, I was saying yesterday, it's a coin flip here. We either break up or we break down, and we broke down. And that's been a kicker for the dollar as well. We've got a bit of a support area down here, 420s, 424. That's the next level. It's bounced already. Now we might do the same game between these two posts. So again, keep an eye on that. The dollar will react whichever way it break back up. We'll probably see the dollar going a bit bid down under here. Probably get another leg up in euro, dollar, cable, Aussie, all those dollar pairs. Right, Kate, over to you, mate.
Yeah. I was actually going to show the US 10s as well. I'll quickly move on from it because you showed them already. Just to show you here this line here, going back to March, which was our first peak above after we've done this one, was our next peak above 4%, and then we hit our head against it as well, retested it, and then we started that last leg up to the 5%. So I reckon there anywhere between 4 and 410, if we get down there, it's going to be major decision time for the US 10s. But I'm straight away going to go on to what Mark was asking. We've been watching this channel here in the Aussie, and I've been showing it here on the show as well. And I've been showing it when it was around here, saying that if we can get a break above this 65.25 and hold, which it did, there's a chance before the month is over we are going to have a visit of the trend line, and that's exactly what we did. You also have the 61.8 there, a 66.60. We overshot it a little. Again, if you look at the timing of this move, is all around Tokyo fixing, RBNZ, and after the Australian CPI. Okay, I think we really need to respect it, and not necessarily for the next 24, 28 or 29 hours until the 4 p.m. tomorrow fixing. But for what comes beyond, for what comes afterwards, once we start to trade December for a starter, although we know like the end of the year and whatever, yada yada. But in the meantime, I think we really need to respect it. Okay, if we are start of December, and let's say for instance that we are here, and the second, third after Powell, let's say for instance after Powell, we are above here. You close the week above, then we maybe start to think about pushing up into the 68s. Okay, if we are below, I think we really need to respect this channel still. All right, it is a strong enough one. We had 1, 2, 3, and a fourth touch right now, so it is a strong enough one in my opinion. So that's the level that we need to respect. If we start to fail or turn around, or if the dollar starts to turn around a little bit post end of month, I think here is your zone to monitor, is 65, 80, 85. If you start to move back below 65, 80, 80, 85, I'm not saying the party is completely over and we go all the way back down to 62s. That's much too early to call, and we don't know what's going to happen on yields. But there is a fair chance that we are going to have a revisit back to around 64.80, 64.60, you know. But that is for your question about the Aussie. I did run it up. This move, I was here. This move, I was part of it, and took another bit off when we were around the trend line, and took the rest of this morning, because what I'm seeing in the market, and what I've seen over the course of the night, because I was up for the RBNZ and the Aussie CPI, and then was watching the clock as well on that Tokyo fixing. It does seem to me like because we put in the high on the Aussie dollar around Tokyo fixing time. Of course, the Kiwi is slightly different because we had the RBNZ keeping a very hawkish stance, but that as well, if you look at when this move occurred, it happened on the RBNZ. Tokyo fixing, you had a bit of a setback, a retest, and the party was over. So a lot, I think, had to do overnight with what the Japanese had to do on their fixing, that is selling dollars, which is also what the models are telling us that they need to do. But I do think that if we get another run up in this Kiwi, perhaps end of month or so, there's going to be a bit in line with what happened on the Aussie. A lot of resistance around 62.25 up to 62.5, 62.60. There's other levels on the longer term as well. 62.25 up to 62.60. I think there's a lot of resistance, and if we are there towards the end of the month, let's say, just for instance, I'm not saying we will be there, but if we would be up there, then we have to see what happens at the start of December. To the other side, we are on a little bit of a level here, but then I would really watch out what's happening if we start to get back below 61. If we start to test this prior high and hold it, then there's a chance of doing the next leg. If we start to fall back here, then we could be in for it could have just been November, end of month, and we start to trade back lower. That for the Kiwi. Dollar yen as well, as we already it was the end. It was fixing time, but just to add a little bit to what Ryan was showing, I've also identified this 146 3060 zone is 3065 is really important, because we have a trend line coming in there as well. One could argue that this is the longer end trend or channel, and this is from early 2023. So your whole 2023 rally in the dollar yen may depend on whether this 146, call it 3060 zone, is holding or not. So that is really going to be a very, very important zone in my opinion. And again, I reiterate what I said. If you look at the yen crosses, Kiwi yen still trading at lofty levels. Aussie yen is still trading at lofty levels. We're coming to tickle supports and perhaps like failure levels or reversal levels, but for the time being, they're still holding, and that is still going to be one of my really things that I need to see to say like, okay, now the yen is going to strengthen and to stay stronger for longer. Euro sterling, Ryan already showed it. I'm a bit short in that stuff. I think we can see a bit of a push lower into month end as well, based on my findings, what month end flow should show. But there is definitely a bit of support here around 86.5 on the euro sterling, and below there, nearly every 15-20 points. They have been traded so often, so much in that euro sterling over the course of the months and everything, that we are going to find levels every 15-20 points. I hope it's not a strategy, but if I'm correct, I think if we see an acceleration, it could bring us down to low 86s, but then we are going to need to reassess. I'm not saying this whole thing is reversing back to 85, far from there. But we'll see. We are working on this zone right here now in the 50-60s. It's bouncing just slightly right now. Likely a bit of flows again going through probably on the euro or sterling side of things. There's one that I would like to talk about, and that's dollar Schweiz for the month end, because I also think that Swissy may be one that is a currency that may remain a bit into month end. So either you look at the dollar Swiss, which now has clearly broken sub this 88.20 retracement and even horizontal. It could have been an inverted head and shoulder, but that party is now seemingly over, at least for now. So this is going to be a very big level to watch once the month end is over. I do think there is a possibility that we are going to have a look a bit lower here, also on the Euro Swiss. But the Euro Swiss is likely, if you look at this, we are retesting already prior support, but if we get a move back down to under 96, I'd keep an eye on what's happening here. We've got a few moving averages around here, and keep a close eye on what's going to happen just below 96, the figure, because you see there's been activity around here as well. And to me, the S&P is done as well, hiking. So I'm going to be looking at a bit of stuff in the Swiss. If we get a more strength in the Swiss franc, I might start to look at a little bit of stuff tomorrow evening, or the start of December. I think, oh, the other one that I mentioned on F.A.C.E as well. I'm monitoring this dollar rand, because we've seen a lot of weakness in other dollar pairs, but this one is not really giving up that much. No, if it would have been in line with other dollar pairs, we should have been trading lower towards the low end of 18 in the dollar rand. This is one I'm going to keep a very close eye on for where we close tomorrow, and hopefully we see a decline into that zone. And this is one where I may be trying to catch a knife come tomorrow evening, providing that I get it low enough, because for now it's still relatively stubborn. Yes, we have corrected a bit in line with the other dollars, but for compared to the others, it's not correcting that much. A little bit like the MEX, by the way, which is also trying to make up its mind over here. This one, the Euro MEX, is one. If EU CPIs come off, and I know that Banxico is also starting to talk about caution about hikes and stuff, but we still can't forget that this is an 11% currency, and even if they cut their rates for down to 10% or so for a starter, it's still going to be 6% above what 6% above where the ECB is, and ECB with the CPI coming off, perhaps also thinking about lowering rates relatively soon. So this is what I'm going to keep an eye on as well. And that is it for me for today, Ryan.
Thank you very much, good sir. Great stuff as always. And thank you as ever for you guys and girls coming and supporting us here on the Flow Show. Don't forget to check us out on F.A.C.E later as well if you want even more analysis on the markets and what's going on. Have a great day, everybody, and trade well. We shall see you all nice and early tomorrow. Have a good one.
All right.